Welcome back, folks. I'm here with the bond king himself, Jeffrey Gundlach. And Jeffrey, teased the debt. It's something you've been concerned about. We're racing toward 40 trillion. Believe it or not, at one time we were zero. Here's my problem. Here's my concern. I don't think we'll ever stop. I don't think either party will ever have the willpower to slow it, maybe to stop it, maybe slow it down periodically. So the question is, what's the ultimate outcome?
Well, it does seem like we're not going to stop it. I mean, we've got the tariffs put on, and they are bringing in some money. I mean, it's not the 500 billion or trillion that the president says it is, but it is ramping up. And we are approaching about a run rate of 400 billion. But then the president turns around and he says, I'm going to give $2,000 tariff rebate to families, and I'm sure it'll be limited to a certain income level. I've heard 100,000 being bandied around, but I mean, depending upon what that level is, that $2,000 to these households would be somewhere between $400 and $600 billion. So we finally got some revenue coming in to help bring the rate of the deficit to GDP a little bit better. But here we are talking about giving it away.
Yeah.
So it does seem like it's never going to stop. Meanwhile, the bond market has started to act in an unusual way in the Treasury bond market, which suggests that we're getting closer to the hand maybe ultimately being forced here for the Treasury Department and the Treasury officials. And that is that the Fed started cutting interest rates, a year ago, September. And they cut rates 150 basis points. And typically, when the Fed starts cutting interest rates, particularly when they cut it as much as 150 basis points, you get a rally in the bond market. You get a rally all across the yield curve. This time, cumulatively now, with 150 basis points, the two-year Treasury yield is barely down from where it was the day before the first Fed rate cut. And the 30-year Treasury bond has a very negative return since that time period. This has never happened before. Another thing that's interesting is that the S&P 500 corrections, going back to 2000, there have been 13 of them. And when the corrections came, the correction just means a drop of at least 10%. The first 12 times of those 13 historic examples, the recent 13, the first 12, the dollar went up every single time. The dollar rallied when the stock market fell, which meant that the dollar was a flight to quality asset. Earlier this year, in response to the tariff tantrum, the dollar fell as the S&P 500 went into correction mode, and it fell by around 8 to 10%. Something funny is going on here, that the Fed cutting interest rates is not really helping the dollar, certainly. Right. Obviously, it wouldn't on a relative basis, and it's not getting long bonds to rally. So my thesis has been for a long time that long rates are going to rise even if the Fed cuts interest rates, particularly if the Fed is cutting interest rates in response to heightened recession risk. Because if there's a recession, we know there's going to be a deluge of Treasury borrowing. It has to be, because tax receipts go down and unemployment stuff goes up. And so you pay things up. When that happens, the problem with that is the long bond going up as issuance goes up, the yield going up is going to take us to a very nervous place, where we already have interest expense having gone from 300 billion a few years ago to now up about 1.5 trillion and going higher, because all the bonds that are rolling off in the next 3 years, based on today's interest rate structure, will have higher coupons than the ones that are maturing. So we have an interest expense problem and an issuance problem. So here's my thesis, Charles. I think rates are going to go higher on the long end until such time as it's too painful. And I think that might be somewhere approaching 6%. Oh. It might be too painful, and they say we have to do something about this. Right. And one thing could be buying back the bonds, yield curve control. They did that in the aftermath of World War II. Or else something really radical could happen, like you change the coupons on all the bonds. Can't change coupons on existing Treasury bonds, you say? Well, that's what they said about mortgages prior to the global financial crisis, and they modified the interest rates on all the mortgages. If that were to happen, it would solve the interest expense problem. You could drop it by about 2/3, but then, of course, you wouldn't be able to borrow anymore.
Right. No one would ever lend you money. Yeah.
That's the goal. That's the goal. We want to get to a place where we're not borrowing any money.
Okay. Less than 4 minutes, though. I got to get your thoughts on this market, the AI bubble. Are you concerned that there's an AI bubble?
Well, it's obviously a huge momentum investment. There's so much passive investment now. The passive assets and passive funds crossed over the assets and active funds, and that just means that money pours in, and they're buying the market cap weighted indices like the S&P 500, and so it's a virtuous circle. And it keeps going until such time as cracks start to appear. I'm not saying cracks are definitively here yet, but things are starting to happen, like I mentioned about the bifurcating of yields and CDS in the AI-related categories. So at some point, it's going to reverse, and the virtuous circle will turn into a vicious cycle. Based on PEs today and the huge amount of non-transparency that's going on in private credit and other things, I'm very cautious. I recommend 20% cash in portfolios. I recommend 40% stocks, mostly foreign stocks like EM in local currency, which has been doing great this year, and then maybe 25% in bonds, where you're taking 10 years in maturities, and commercial mortgage-backed securities are doing very well. There's reduction of fear in the commercial real estate market. And also, the risk-free thing are non-guaranteed mortgages, residential mortgages that were issued 5 or more years ago, because no one is going to default on those mortgages. They have way too much home price appreciation. You'd be stupid as a rock to default on a home when you can sell it for a profit. So there's no credit risk in those residential loans. The commercial market is definitely getting some animal spirits showing up. Maybe it's just in general, animal spirits been picking up. But that's how I see things, and 20% cash. And still, I like 10% or 15% in real assets. Some people can buy gold. I do observe that over the past 12 months, gold has gone up over 50%, and Bitcoin has done 0. So it looks like the market is getting a little bit more sober about what's real and what's hype. And at the valuations of the hype assets, I don't want to play just in case the momentum flips the other way, which it probably will within the next year.
Less than a minute to go. The Fed, should they be focused more on jobs right now or inflation?
I think they are more focused on jobs. The unemployment rate's been going up. It's now almost 50 basis points above its three-year moving average. It's likely to move higher based upon the anecdotal data we've had since the government shutdown. And the inflation rate the inflation swap market has actually come in. I think the tariff effect on the CPI, people are starting to think that it's dissipating, and I think people don't expect inflation to rise as much based upon the inflation swap market. So the Fed is going to be more focused on jobs, I believe.
I believe so too. There's an enormous amount of economists who don't. Jeffrey, I really appreciate you spending all this time with us. We covered a lot. Thank you so much for your wisdom, and hopefully we'll see you again real soon. Thank you.
Thanks for having me, Charles. Good luck, everybody.
Thanks.